And we are live. Great. So welcome everyone to the first live video or Insta Live of developing economics. So I see some people are already checking in. Great. So starting on the minute. So for those of you who don't know, hello, people are saying hi. So for those of you who don't know, this blog, Developing Economics, is about breaking down complex critical work, approaches to economics and development, and making it accessible to the public to stimulate debate, to stimulate cross-disciplinary dialogue. And we do this through blog posts so far, up until today. So today is the first Insta Live session that we have with Johannes Petry. And I'm going to add him to this story in a second. But first I wanted to introduce him a little bit. So Johannes is a postdoctoral research fellow at the Free University in Berlin. And he's contributed a couple of times to the Developing Economics blog. But his most recent one is the blog post, The New Passive Wall Street Consensus. And that's based on a paper with Jan Fichtner. And the paper has a bit of a mouthful of a title. So we're going to break it down. But so the title is Steering Capital, the Growing Private Authority of Index Providers in the Age of Passive Asset Management. So the blog post breaks all of this down, but I'm going to get Johannes to break it down even more. So I'm going to invite him into my story. Hi, Johannes.
Hi there, how's it going?
How are you?
I'm good, thanks. How are you?
I'm doing good. Yeah. So I'm excited to have you here on the Insta Live.
Thanks for having me.
As you can see, people are already kind of checking in and waving at us. So I'm gonna just ask you questions to get you to break down this kind of complex research that you've done that is clearly very important. So first question I want to ask you is, well, first of all, I mean, in this context, you write that, in the past, during the time of the Washington Consensus, many developing countries faced the IMF and the World Bank as their main counterparts in terms of global finance. But in your research with Jan, you find that you argue that there's an ongoing paradigm shift, and that financial markets are changing profoundly, and you identify these index providers as the key actors in this new paradigm. So what is an index provider, and how do they impact developing countries?
Thank you. Great question. So basically, an index provider is the company that creates an index, so indices such as the S&P 500 or the FTSE in the US or the FTSE 100 in the UK, they basically provide it's a measure to evaluate the performance of, let's say, a basket of stocks or bonds, for instance. And very often these, or by now, these benchmarks, these indices are really almost used synonymous with the stock market as such. So the S&P 500 is basically synonymous with the US stock market and thereby also the US economy to some degree. And I mean, these indices have been around for a long time, right? The first indices were created back in the railway boom in the US in the 19th century, and was really, just to see how actually the stock market is performing. It was an information measure. And so they were usually printed in newspapers. So the guy who invented the first index, the Dow Jones Industrial Average, that was Charles Dow, who also founded the Wall Street Journal. So there was always this connection with information about the market. And index providers have retained that role, but what they have also been doing in recent years is their influence has been growing tremendously because of what we identify as the age of passive asset management, which is also in the paper title. And that's basically what we argue is that with, especially since the global financial crisis, what you could see is a shift from active management of assets or active investors who try to beat the market, outperforming the market, towards more and more investment into passive index funds that basically reproduce an index. So they grow with the market, they don't try to outperform it. And thereby, we argue that index providers have become much more important. So their decisions to create indices, whom to include in an index, whom to exclude, and for which reasons they do that, they have become much more consequential. I mean, just to give you an example, in the US, 50% of all assets in the stock market are by now invested into passive funds. So, I mean, they do have a huge impact. And when it comes to developing countries, you do also see that impact because basically index providers decide into which countries international investors invest. So if you are included into the MSCI Emerging Market Fund, billions of dollars will flow into your stock market, basically. If you're excluded, because you might have introduced currency controls, billions will. And this is why we argue that they have become really consequential, their actions, and therefore important for developing countries.
Yeah, great. And now this is perfect because you also explained, in case anyone is wondering, what is passive asset management? You also broke that down, so that's awesome. And then, so how is this paradigm shift then?
Sorry?
So how is this a paradigm shift?
Right, yeah. So, I mean, what we argue is, and this ties into the work of Daniela Gabor, for instance, who talks about the Wall Street consensus, kind of replacing the Washington consensus, so basically selling development finance to the market. And we argue that index providers have become key parts within this kind of new Wall Street consensus, where development is pursued through finance. I mean, there's also the World Bank's maximizing development through finance initiative and so on. So in this context, index providers, we argue, have become much more consequential. You can really see that also kind of the assets that track these indices, both for developing countries and developed countries, have grown tremendously in recent years. So, yeah.
Yeah. Okay. And then, so you also write in the blog post that this is a form of financial subordination, which is kind of a term that a lot of scholars are using now to describe finance in developing countries. So what is that? And can you just elaborate a little bit more on how index providers fit in with the financial subordination stuff?
So what we see in our research is that, I mean, a lot of developing countries are really sensitive to the decisions by index providers, increasingly so. I mean, one good example, for instance, is, I think it's a story that we also have in the blog post, the example of Peru, where the finance minister rushes to New York in the middle of the night, not for some diplomatic emergency, but because there was a rumor that MSCI might downgrade them, because the rumor has actually led to a 5% drop in the stock market within a couple of days in the Peruvian stock market. So we argued this is a kind of a new form of financial subordination, because it's not really about the IMF or the World Bank dictating the terms of how these countries should behave in order to receive finance or some, let's say, hedge funds, such as in the Asian financial crisis. But it's really index providers that kind of set the tone and kind of set the rules of the game of what you have to do to be included or not to be downgraded to a lower category where not so much money is, not so many investors kind of invest in frontier markets, for instance. If you are emerging market, you downgrade to frontier market, that basically means that investors will reallocate 90% of the money that they have in your market if they track the index. So yeah, that's why we think that this mechanism of the inclusion and exclusion is really a mechanism that explains kind of this relationship between developing countries and global finance quite well.
Yeah, yeah. Yeah. Sorry?
This unequal relationship, yeah.
And yeah, exactly, very unequal. So, given that, yeah, this is not an ideal situation for developing countries who are subordinate in this relationship, do you have any thoughts about what can be done to address this inequality?
That's a good point. There was recently a paper published in, I think, the Harvard Law Review, which was then picked up in the FT, and they basically argued that index providers should really be regulated to a much larger degree as investment advisors, for instance, because at the moment the activities are not really regulated. It's not like, I mean, credit rating agencies are highly regulated, index providers not so much. So kind of having a bit more political control over what they're actually doing would definitely be a step in the right direction in terms of getting them to kind of having more scrutiny about what their activities actually, what the effects of their activities are.
Yeah, so that's kind of from our side, right? So we kind of demand more transparency from them and control. And in terms of developing countries, is there anything, I mean, yeah, are there different strategies that they can pursue? And what's kind of the best strategy for a developing country, in your opinion?
That's a great question. Well, I don't really have a good answer to. It's very difficult. I mean, one example, for instance, is South Korea is an OECD country. It's highly developed, but it's still considered an emerging market because it does not allow certain activities such as trading financial derivatives on the stock market, for instance. So it's very different. There's very little leverage for developing countries in this regard, unless they're huge, such as China. So China, for instance, I mean, they were included into the emerging market index, indices of MSCI and FTSE and so on. But it's China, right? And it's the second largest capital market in the world. Everyone wants to be in China. So they had some leverage to kind of push the index providers a little bit. If you're a small country, it's very difficult to do that because they also hide behind a veil of technicality. So it's difficult.
Yeah, right. So then all they can do is kind of rush to New York to to beg to be not be taken off the thing. Okay. Okay. So and you said that because this kind of discussion is something that is very often kind of very technical and political, as you mentioned. And you said this is the first kind of study, a political economy study of index providers. So can you talk a little bit about what that means, like a political economy study, and why is it important that we study index providers from this political economy perspective?
Right, yeah. So, I mean, there's all these index providers have these methodologies, and they're open to the public of how they assess these inclusion and exclusion, and also how they weight countries within their index. But actually, if you look at how these, and that's what we did in our study, we actually looked at, okay, how does that mechanism actually function? What do they do? Yes, I mean, there's certain technical things such as you need to have a certain amount of companies with a certain market cap to be able to be included. They have to have a certain liquidity. But these are all, I mean, a lot of countries tick these boxes. The crucial thing where real decision is made about inclusions or exclusions is market accessibility. And this is something that there's no fixed metric for that. This is basically you have committees who then, I mean, they will ask some of the market in a consultation, okay, what do you think about that? But essentially, in the end, the index provider, committee at the index provider will decide whether to include or exclude a country based on certain criteria that are, I mean, very much political. Should your capital market be open to foreign investors to roam freely, do whatever they want, with hot money going in and out, creating bubbles or busts? Do you want foreign investors to be able to speculate with derivatives on the movement of your market? I mean, the interesting case here, for instance, is the case of India, which actually forbid the use of its stock market data because in Singapore there was so much trading on kind of with derivatives on the Indian stock market that this moved the prices of the Indian stock market. And the exchanges said, well, actually, we don't want that. And then MSCI threatened to downgrade them. And in the end, they kind of negotiated some kind of mechanism to trade the same products within India. But then again, one of the really large emerging markets, right? And this is where we think a political economy perspective is really helpful to actually assess how these different normative assumptions of how markets should function, how these different power relations play out in these seemingly technical inclusions and exclusions.
Yeah, great. And so, given that this is so important to study from a political economy perspective, and that this is the first paper, just out of curiosity, is this something that you are pursuing further and looking at other aspects of index providers as well? And what's sort of your next research on this?
Yeah, no, that's a great question. We're definitely still pursuing that. We're actually at the moment, writing a book chapter which really focuses on emerging markets and that relationship with index providers. So, because I mean, the paper that kind of where the study is based upon is a broad overview of a kind of all the different aspects from the shift towards passive investment and kind of how private authority is formed, index providers, how the industry is kind of concentrated. So you have these three large players basically. Basically have an oligopoly. The impacts on corporate governance in kind of the development world is something that we look at, as well as the issue of different countries. And basically all these different things we want to explore in more detail. So which indices actually matter? So we had access to a database recently to actually look at which of these indices do matter. And it's very highly concentrated, even more so than the measures that we had before. Emerging markets, something we really want to look at, the inclusions and exclusions, what they actually, what the relation is with, concretely with asset in and outflows out of countries, with changes in financial regulation, and really exploring these power relations a bit more. So there will be a book chapter hopefully soon coming out and more possible.
Yeah, great. And hopefully a follow-up blog post maybe on developing economics, potentially. So I have a final question that I think you kind of you talked about a little bit, but not explicitly. So I just want to ask it explicitly so that people watching get a sense of like why this is super important if they're not already convinced. So my question is, why does it matter? But I'd like to add also, I guess, how it matters. I guess there's a bunch of different ways, but yeah.
Why does it matter? Yeah, that's a good question. So, what we try to do is we really try to understand the economic impacts of these decisions made by private financial actors. I mean, they're not democratically elected or whatever, but they basically decide over the fate of countries, companies in these countries, and the people employed there, basically. So that's why we think these decisions, they do matter. They because they are quite consequential, also on a societal level. And this is something that, because it is so seemingly technical, that this has to be unpacked. And I guess also this is kind of how it matters as well, because it actually, I mean, it cements some of the power relations that are inherent in the global financial system as well. It is very biased towards kind of a neoliberal idea of how markets should function. One other example that we mentioned in the paper, I think, is in the 2000s, a lot of the index providers, they shifted the methodology from overall market cap to free float, which basically meant that over a period of a couple of years, I think 1 or 200 billion US dollars of capital flow went out of continental Europe and Asia, where you have more strategic block holdings, more family ownership of companies, and actually propping up companies in the US, in the UK, and really cementing issues such as shareholder value orientation and these, kind of ideas of how capital markets are supposed to function, which are very much tied with a neoliberal policy paradigm of privatization, marketization, and so on. And tracking that and addressing that is something that we hope to do.
Yeah. Cool. So I think that was a really good explainer of your research. Is there anything that you want to add that I haven't asked about?
I don't think so, no. Really great questions. I think we covered most of the important points.
Yeah.
The chance to explain everything.
Yeah, no, that was great. That was really good. Cool. So I think, so I'll, to those of you that are watching, I guess I'll post this on Instagram and then so people can rewatch if they want and really study index providers in depth. And I'll put it on YouTube and stuff. So there will be a chance to kind of revisit what Johannes has taught us today. It was great to see you, Johannes. And hopefully see you soon.
Yeah, definitely.
At least in cyberspace, probably not in person, but yeah. Great, thank you.
Fantastic. Bye-bye.
Bye.